Hello, everyone. My name is Richard Leggett. I'm the CEO of FrontierView, and on behalf of my colleagues, we welcome you and thank you for joining this episode of GlobalView. I'm joined once again today from hot and sticky London by my colleague Elizabeth Rust, who's our senior analyst for global economics. And we're here to talk again about some of the major macro level issues that are top of mind for our multinational client executives. There's a lot that we can cover this month, but I think there's one overarching topic that I'm hoping we can talk about. Maybe we can talk about it across kind of three different dimensions. Elizabeth, first of all, welcome. It's good to have you.
Thank you.
I've noticed in the last few weeks there's been a surprising drop in prices for a number of major commodities. And last month we talked quite a bit about oil prices, and we shared our view that the decline likely can't continue, and that there's probably a floor under oil prices. But now what we're seeing is that the drop isn't just limited to oil. We've seen drops in wheat prices, copper prices, aluminum prices, and go on down the list. And these commodities are obviously critical product inputs for many of our clients. And the rise in those prices were behind a lot of the cost pressures that our clients have been experiencing for the last year. So to kick everything off, the big question that I think we're hearing from a lot of our clients, which is this commodity price drop for real? And can we expect input cost pressures to start to fade from here on out?
Yeah, it's a topic that I think it's about time we took on. And that's because it has featured a lot in client discussions for the reason you say, that it's been a big source of the input cost pressures our clients have been dealing with for the last couple of years. And it also matters a lot with respect to all of our assumptions about where inflation is going around the world. So let's talk about it. So actually, I can share with you a way of summarizing this. Basically, it's our cost outlook across some of the key categories of input costs experienced by our clients, a number of commodities as well as shipping. And under this cost outlook, red basically points to high prices with potential for prices to rise further, just based on extreme tightness in the market. Orange represents high prices, but sort of equal likelihood that prices could rise or fall going forward. And green points to easing prices or low prices, basically back to the environment that we were in prior to the pandemic. So basically through 2019, you were seeing a lot of green for these commodities for several years. And then starting during the pandemic, costs for shipping started to shoot up, obviously in the first several months of lockdowns. And then beginning in 2021 is when you saw prices shoot up for a number of these other commodities. So just real quick before we talk about the future and our kind of expectations for the next year, regarding the recent price drop, it began in early mid-June. And you're right to note that it's not just oil, although that's what's grabbed a lot of the headlines. It's been broad-based across quite a few different commodities. And there's a different story for every commodities, as always with commodity market analysis. You can get into tons of details, but just speaking actually big picture, there are probably three reasons for this broad-based drop. The first one has to do with fears of a global recession, an imminent one that could manifest in the next year or so. And the idea there being that in a recession, you get some amount of demand destruction for these commodities, decline in global industrial and manufacturing activity, decline in consumer mobility. Maybe people choose to drive around and fly around less as incomes come under strain. That drives down oil prices, for example. So in a recession, the idea is that takes away some amount of demand for these commodities, and that pushes down prices. So that's the first reason. And it's well-founded because, and for any clients who've been taking a look at our global outlook research in the last few months, we've focused on scenarios for global growth in the next 18 months, and we think it is quite likely that the global economy will be in a recession in the next year or so. So that's a well-founded reason for the drop to some extent. The second reason has to do with China and weaker demand, commodity demand coming out of China. And there are two reasons for that. One is the persistence of zero COVID, the realization by the market that even though Shanghai and Beijing are no longer under the really severe lockdowns they were in April and May, China's not fully reopened. people still have to test in order to leave the residential compound. So that takes away a lot of demand for transportation fuels, so that weighs on oil prices in particular. And also due to this weakness in the property market has taken out a lot of demand for metals. So that's driven down metals costs to some extent. And the third reason is the realization that a lot of the war-related supply disruption that the market feared right after Russia invaded Ukraine has not fully manifested. Certainly for oil and natural gas, there's been quite a lot of disruption. But even for oil, it hasn't been quite as severe as expected, like in large part due to leakage. Russia is still selling crude to other markets, even despite the EU oil embargo. And there haven't been sanctions on some of these other commodities. So that's resulted in less disruption than originally anticipated. So those are kind of the three big picture reasons. We do see quite a bit of orange. So even though, good news is some of the drop makes sense, we're probably not going back to those extreme high prices and price increases that we saw in February, March, April. But it's taking a while for prices really to come down back to more normal pre-pandemic levels. And so prices are likely to remain high through 2023. So that's kind of the good news and bad news in terms of the cost outlook for these commodities. Most of our clients are still going to be feeling those high prices for a little while longer.
Okay, I want to take each of them in turn, but before I do that, just follow-up overarching question, because there is a lot of orange and red on this picture still. And I guess, would you say that your bias is more towards the downside in terms of pricing, or is your bias still that there's still more upside? And I know each one is a little more nuanced, but overarching, would you say that we're more likely to see this picture turn more red, or we're more likely to see it turn more green?
Sure. So I think the colors more or less represent where the bias is to the upside in terms of prices potentially rising further. So where you see red, that's where the bias stands. And orange points to balanced risk. So, I mean, the downside biases mainly really just mostly have to do with recession risk. So basically, how deep could this recession get, and how much demand might be taken out of the system under that global recession scenario. Whereas the upside biases have to do both with potential surprises around demand. Maybe we won't get a recession, which is not what the market is really anticipating right now. So that could push prices up. And then there's, where it's potential for further supply disruption. You've got, certainly there's, geopolitical tensions casting a pall over a number of things, obviously with, China and Taiwan and some developments there in the last couple of weeks, really bringing that to the forefront. So there's, I would characterize the market as still fundamentally tight. And whenever you're in a tight market, it doesn't take a lot of supply disruption or surprise increases in demand to really push prices up again. And my view is that the market has understood a lot of the downside risks around recession, and is, potentially it's time for it to revisit some of the upside risks, if that makes sense.
It does, yeah. All right, let's take each of the commodities quickly in turn, if we could. So let's start with food prices. We know, kind of going back to the Russian invasion of Ukraine, that provoked immediate concerns about the risk of global food shortages and potentially famine. As I understand it, I think you've mentioned this several times, Russia, Ukraine, and Belarus produce about 10% of the world's calories. And some countries, particularly in the Middle East, North Africa, are very dependent on the food supply for that region. But we've seen food prices falling. And does that mean that there's an end to the concern about global food supply?
Yeah, it's a good question in light of, again, just like with, the commodity story in general, we've seen a drop in food prices recently. And that's both on, I'll share first kind of the consumer price index side. So this is the real global food price index from the Food and Agriculture Organization of the UN. And it can be thought of as a consumer price index for food. So it reflects the prices that consumers are actually facing and the costs that they're paying for food.
Still
And
incredibly
you
high
saw,
versus historical
yes.
levels.
Yes, and you're going to see there's a theme throughout this presentation, which is we've seen this drop in the price of whatever commodity you're talking about, and yet prices are still very, very high, high. They're just coming off of recent highs. And so that's certainly the case here. So you can see that 2022 line is still well above where it was throughout 2021, which was already well above where it was in previous years. With that said, though, food prices plunged in July. It was the biggest drop since 2008. And that's certainly a welcome development. It's sort of back down to pre-invasion levels. So it appears that a lot of the war-related supply disruption and fears there have eased quite a bit. And the decline there was driven by declines in prices for grains and vegetable oils, which was responsible for a lot of the increase before. And that's because Russia and Ukraine and Belarus supply, are particularly big in global grains and vegetable markets, especially Ukrainian wheat and sunflower oil. And so you've seen a bit of an easing there. And one big reason is sort of one I alluded to earlier, the war-related supply disruption hasn't been as bad as anticipated. And a lot of that has to do with actual concerted effort on the part of governments and international organizations to get ahead of this problem. So you've seen obviously a lot of statements by political leaders and international organizations in the last few weeks, media interest in the issue of the risk of global famine. And if that problem goes away, it's because there was action taken to combat it. So you saw this UN-backed deal to get wheat exports out of Ukraine take shape in the last few weeks. You've also seen the EU deliberately avoid targeting Russia with sanctions on anything that could touch food supply or fertilizer supply. So even though there's been obviously a lot of interest in putting in an EU oil embargo and natural gas has been targeted, etc., the EU is still buying food from Russia, no problem. It's due to this concern about disrupting global food commodity markets. So that's behind that recent price drop. And again, it is reflected to some extent in measures of global consumer prices. One thing that's interesting to note is so far you're not seeing much evidence for this on the country level. So if you look at July CPI prints for several major markets, the US one came out yesterday, which we can talk a little bit about. In the one for the US, for example, you're still seeing very high food inflation, and the same goes for several other countries as well. So that's a little bit of an anomaly, or this overall index isn't necessarily reflected in country level data, at least not yet. But if you look also at prices for food commodities, you can see kind of trends in individual, particularly grain commodities. You see wheat prices have eased pretty much back to pre-invasion levels, but kind of underscoring the fact that, let's not celebrate too soon this price drop. It is mostly driven by wheat. And you can see, again, prices are still very high relative to historical average. So even though wheat is back down to like January levels, it's still quite a bit above where it was in 2018, 2019. Soybean prices have barely eased at all. Corn is down a bit, but again, historically elevated. And then one other important grain that isn't featured here is rice. Rice prices have been much lower calorie for calorie than for these other grains. And that's actually one big factor that has been helping keep global food prices down. Part of the reason you're not seeing a lot of inflation yet in Asia is due to low rice prices, and yet rice prices have been inching up quite a bit in the last few months, and you've seen a recent acceleration there. And so that's provoking concerns potentially about export bans by rice exporting markets. You've seen weaker rice harvests in kind of the early part of the season in India and Thailand. So there's still things to be concerned about if we look toward 2023. It's a little bit early to celebrate the end of these fears about famine. Another reason why it's a little early to celebrate is obviously big input to agricultural production is fertilizer. And you can see in this chart, prices for fertilizers are still historically very elevated. and they haven't really come down. They've just stabilized at a high level. Again, same deal. Some of that is the supply disruption hasn't been as bad as thought at the beginning of the war. But there's probably some supply disruption looming on the horizon if you think about high natural gas prices in Europe. Europe produces a lot of fertilizer, and natural gas is a major feedstock to fertilizer production, particularly for nitrogenous fertilizers. So there's a risk of fertilizer prices rising in 2023, feeding into higher food commodity costs as we get later into 2023 and even beyond. So again, good news that we've seen lately with the drop in wheat prices, but it's a little early to call it the beginning of the end of this problem.
Okay, very helpful. Let's shift to metals. So it seems like we've seen a similar story with metal commodities. Huge surge after the invasion due to fears of supply disruption. Russia is a big metals exporter. Back in March, the London Metals Exchange had to shut down nickel trading for a week when the price doubled in a matter of days. But now we've seen again prices plummeting in the last few weeks. Is it the same sort of story with metal and metal commodities as we look out in terms of the future?
Yeah, a little bit the same phenomenon. And you take a look at the time series here, and it actually looks a little bit like the same shape as the one I showed for grains a minute ago. Prices peaked after the Russian invasion, shot up and then peaked after Russia's invasion of Ukraine, and have come down quite a bit in recent weeks. What's interesting for metals is the come down has been even sharper than for food and some other categories of commodities. So if you even compare the price of some major base metal benchmarks to the beginning of the year, so quite a bit before the Russian invasion, prices are even negative, down from January 1st. But again, similar theme where prices are still historically elevated for some of these metals, sort of too early to call a win on this. The thing with metals is the reason the come down has been a bit sharper is you've got two cross currents moving here, and it's a little bit of a different story than for food. If you think about food commodities, there's higher demand and elasticity for food. People need to eat regardless of what's happening with the global economy and how growth is going. Obviously, food commodities are used in some, other applications aside from human consumption. But for the most part, there's some amount of demand for food commodities, regardless of what's going on with the global economy. It's not the same for metals. And so you've seen a sharper come down where recession fears have dominated the trend for metals. So even though there are concerns about supply disruption in 2023 for metals due, again, to high energy costs, metals production is very energy intensive. So we could see some serious production shutdowns for certain metals production, especially in Europe. You still will see kind of more downward price action because ultimately demand for metals comes also from within the industrial supply chain. So if you get a global manufacturing downturn, which we're starting to see manifest, that's taking a lot of demand for metals out of the system. And the other big factor, again, as I kind of nodded to earlier, is China's property market situation and weaker construction activity in China for several months now, which is likely to continue. That's taken quite a bit of demand out of the story as well. China has just been very, very large in metals markets for years now and is kind of a big support of demand. That's particularly the case for iron ore. It's not shown here, but prices there have been actually quite low through all of this. It's really dominated by that China demand story. So a few different things going on here, but if we do get a global recession, you'd expect to see metals prices potentially fall a bit further. So we could see more price easing on the metals side. With that said, if you've got high energy costs and Europe shutting down production on a large scale, that will be a factor supporting prices next year.
All right. Next one I want to turn to is shipping. So what's going on there? Because the shipping prices have been really high for a long period of time, and also our clients have suffered through lots of delays in addition to the high prices. Are we starting to see that ease up both on the pricing and on the delay side, or is it still incredibly going to be difficult?
So you've seen easing there as well. And it actually predates some of this commodity price drop. So that's been a little bit of a story in the background, is easing shipping costs and just supply chain delays and problems. And one way to kind of measure this feeling of like supply chain pressure, which encompasses a lot of different things, it can be reflected in, actual cost of shipping a container of goods or dry bulk. It can be incorporated into cross-regional air freight prices, but it's also this feeling of just, we order stuff and it takes a while to arrive, and we don't know how long it's going to take, and that throws off all our production. You can actually measure it, and the New York Fed has come up with a supply chain pressures index, which incorporates a number of different kind of measures getting at that, a global scale. And you see, again, easing from a peak hit several months ago, but pressures remain historically high. With that said, the trend is certainly down. You see that downward trends and kind of perception of easing pressures quite a bit in business surveys, particularly purchasing managers indices, basically surveys of purchasing managers in major manufacturing centers around the world, reports that supply chain pressures seem to be easing. That's helping to take some of the pressure out of input costs in general. So it may be kind of the early signs of some easing cost pressures beginning that could then filter along the supply chain. But again, you look at the level and it's still very, very historically elevated, well above the costs or just general, pressures and issues that we had prior to the pandemic. And what's interesting in this case is this is in the absence of any clear major disruptor. So, throughout the last couple of years, the big reason for these supply chain pressures has been COVID, shutdowns, manufacturing production being curbed, logistics problems, difficulties moving goods around due to COVID lockdowns, and then obviously the war, China's zero COVID, and a lot of those major disruptors have gone away. Obviously, zero COVID in China is continuing, but goods are still being shipped in and out of China and within China. So a lot of those problems have gone away, and yet costs are quite high. And this kind of indicates to us that this points to medium-term dislocation, that we're unlikely to see a sudden drop in shipping costs that then, we're kind of back to normal. Some of the reason for the decline is just a demand side story. So you had a big surge in goods consumption in the early months of the pandemic, and now people are just buying less stuff since things have been open. They've been spending more money on travel and in-person services, and that's just taken away a lot of these pressures, and you no longer have these major backlogs at at ports in Los Angeles and China and everything. So the issue with this is when it's a demand side easing of pressure, all it takes is an increase in goods consumption again, and we're about to enter this kind of seasonal peak in orders, which happens in the third quarter of every year ahead of winter holidays. So that will kind of really test what's going on with shipping, and that may spell out a little bit more clearly what is likely to take place in 2023. But our overall assessment is a bit more of the same. We're probably past the worst of these disruptions and high costs, but costs are still historically elevated. Our clients still feel it, and it's still, a major consideration in their plans.
Yeah, and also playing into this, which we've talked about in the past, is inventories, and that also has a role to play because there's been a lot of inventory buildup, so we've got to work our way through that as well.
Yeah.
So if I take into account our expectations for commodity prices and input costs over the next several months, how does this all play into our view about inflation? And I'll just throw out that yesterday we saw the US CPI print that showed, I guess, good news in the sense that prices didn't rise really from June to July, and year on year it eased a bit from 9.1 to 8.5%, still high, but at least it's going in the right direction. Are these I guess the question is all of this point to a sign that inflation has peaked and that we're now on a downward trajectory, or is this a little bit of a false dawn in your view?
Yeah. So I think our view, and our view even before the CPI print, is that US inflation, we'll start with that specifically and then kind of go global. US inflation is likely to ease over the next several months. And a lot of that has to do with weakening demand and our expectation that the US is likely to enter a mild recession in the next several months. So we may be past the peak for the US. But as always with inflation, you look into the details and there's still always signs of worry that mean, this isn't over. So I would say overall that CPI print was very good news, as you alluded to. But a lot of the reason for the, on net stable prices is due to drop in energy costs. All it takes is oil prices to rise again, and that story is suddenly over. Food inflation remains very high. You've had easing costs for some pandemic affected services that saw big price increases earlier. So airfare, hotels, car rentals. So you've seen easing prices there, but for some other core categories, rent, wage pressures remain high. There's still a lot of sign of inflationary pressures in, broadening out in the US economy. So I don't think this is enough to call the beginning of a trend, and I don't think the Fed will think so either. So it's unlikely to be this. That report alone probably isn't going to orchestrate a shift in their policy. Globally, with respect to kind of, if we summarize around the world, what do we expect to happen to inflation next year? Our stance is similar to commodity prices. It's going to ease, but it will remain historically high. So we're talking a lot about higher for longer inflation. And that's because it takes a lot of time to kind of iron these pressures out of the system, for monetary policy to kind of feed into the economy. There's quite a bit of a lag there. And there are still kind of near-term factors that are feeding into higher prices in a number of markets. For example, the surge in the US dollar leading to FX depreciation for most major currencies around the world, that hasn't fed into consumer prices lately. And so that's a lot of why you look at country level inflation data and there is no sign of easing pressures for most markets. So again, I think overall our sense is it's too early to call victory on the inflation front either. And companies should be assuming a bit of easing pressures. We're probably past the kind of shock and awe price increases we saw in the first half of this year. But inflation is still likely to remain high for a bit longer.
Okay, and I think all of that implies companies are going to have a harder time protecting margins via just being able to continue to pass costs going forward.
Yeah, and one thing that's likely to make it harder going forward is in the last year, we saw high inflation in an environment of strong global demand. So still kind of accelerating economic growth coming out of pandemic lockdowns. And now we're expecting weakening global growth. It's clearly here. It's a question about whether you want to call it a recession or not, or how bad will it be. But it's clear that demand is weakening. And that implies it's going to get harder to pass through costs onto the consumer or the end user. So for companies where that's been their main strategy for protecting their margins in this high and rising cost environment, it may be time to take another look at that strategy and consider, what are other ways we can manage costs if it's going to, be harder going forward to pass through price increases.
Yeah, this is the classic fork in the road between market share versus margin, I think. So, all right, we are up against it. Once again, Elizabeth, mildly more positive than the last few episodes, so I'm glad to hear that, but things continue to look volatile with trends constantly shifting, which underscores the importance of vigilantly staying on top of what's going on in your markets. Obviously, FrontierView is here to help do that. Elizabeth, thank you so much for the excellent and insightful discussion as always. I also want to thank our producer, Madeline Gordon, for all your help behind the glass. And most of all, thanks to our audience as well. We have covered a lot of ground, as always, in a short amount of time. And as a reminder, As FrontierView clients, you can schedule research briefings with Elizabeth or any member of the FrontierView Global Research team at any time by scheduling through your client service manager. And of course, all of Frontier's research, award-winning Frontier data, and analyst insights are always available and updated on the FrontierView desktop and mobile application. This concludes today's GlobalView episode. I hope you'll join us next month for more insights, and in the meantime, be well.